Well, I'm a big fan of simplicity because it makes it easier to understand and easier to have discipline. And my systems are pretty simple. They used to be very complicated. And I went through a process a number of years ago where I just started cutting out parts of the system so that, did I make as much money? No. I'd make 90% and do only 10%. I was doing the 80-20 principle. And so, yes, I didn't make as much money. But on the other hand, I wasn't working as hard and there was no complexity. So there was no errors on my part. Complexity brings errors. So a simple channel breakout or Dantian channel, price channel, I would start with that. That's going to get you a long way to having a profitable system. And it's very simple, easy to monitor. You hardly even need a computer. You just need a phone and you can pretty well trade it these days. So I would start with something like that. Listen, there's a very famous author who used to work for me many years ago. And I won't say his name because it's a little embarrassing story, but you'd know who he is. I went over to his office one day and he's showing me his systems. He had 107 systems working, okay, 107. Now, I got up to 42 and I thought that was a lot, but 107, I'm going like, wow, this is mind-boggling. But I looked at it and I kept saying, and he even had systems that lost money on purpose to smooth the equity curve. Okay, wow. I'm going like, oh, okay, well, because a lot of institutions want a smooth equity curve, okay? So he reduced his profitability in order to have a smoother, okay. The guy's genius, okay? But sometimes geniuses do stupid things. Well, here's my point. I kept looking at it, I kept saying, if you have 107 systems, you are the market. And therefore, you'll never really outperform the market. Your return should end up being the same as basically treasury bills. So he had attracted tens of millions of dollars. This is in the old days when tens of millions of dollars was a lot of money, and ended up equaling treasury bills, and people took their money back because treasury bills were safer. So complexity is not necessarily a good thing. Complication is not necessarily a good thing. Give up a little complexity, give up a little profitability for simplicity, because then you'll make fewer mistakes.
And quite honestly, when I don't watch my trades, they actually end up doing much better than when I sit there in front of my computer, watch my trades. So what I mean specifically is that, if I put my trades on at 8:30 p.m. New York time for the Asia session, close my computer screen, get on with my life, enjoy a glass of wine, they actually end up doing better than when I'm sitting there with the computer next to me, looking at it every 5 seconds. Well, I think you have two options. One is you pick the time you can trade, right? So for example, if you live in Asia and you work all day, and the only time you have to trade is when you come home, that's fine. I mean, lucky you, because that's the most active market hours. What you can do is you can just trade from 6:30 to 9:30, where you have the overlap between Europe and Asia. I mean, that's perfect. Alternatively, you could be an early riser and trade with me. Well, it's not that early, but 8:30 New York time, and let the position ride itself throughout the course of the day. Or if you really don't have time to be, and you can't isolate those pockets of time, then look for strategies that are based upon daily charts. And I have a turn trader strategy that uses Bollinger Bands that basically only triggers off of daily charts as well. So it's really about finding, it is exactly what you said, really about finding the type of trading style that fits your own lifestyle, because that is when you'll trade best.
I'll see trade setups. They'll post a trade setup, then next week they'll post another trade set. It's a completely different system. Then the next week it'll be a completely different system again. Then they're on a different time frame, that they're trying something else. I get it. You try stuff like that. You do it on a demo account. That's good. But you have to find something and stick with it, and who cares if it's got a 40% win rate, as long as you're making more money based on your returns, then you're losing. But the problem is, with a 40% win rate, that means you're losing 60% of the time. which means that's going to mess with your mind and that, so that there is, and we all know about psychology in trading. It is a big part of it. It's hard for a lot of people to wrap their head around that, pardon the pun, but it is a tough part. And you do a lot of stuff with Mandy and that, and you know all this stuff, like it's a big part of trading. So, then people look for the 80% or the 90% win rates, which are crazy, like, especially when you're starting out. Accept the losses, trade small.
I think our job as traders is always to adapt. Did you ever read that book, Jesse Livermore's book, Reminiscence of a Stock Operator?
Yeah, great book.
It's a great book. And so, if you read, he's one of the most successful traders of all time, but he had kind of a tragic ending, and he ended up, compared to what his wealth was in his peak, he ended up relatively broke. And in his last kind of few months, there's a part of him that laments and says, I just didn't learn how to adapt to the new markets. He was kind of hoping that the markets would stay the same. And the bottom line is the markets are always in flux. I've been doing this for 21 years, and I've gone through like some sort of major crises once every 2 years. You got the flash crash, Swiss National Bank revaluation with the Euro Swiss, London terrorist bombings, 9/11. Like, it comes out to literally one event every 2 years. And the one thing I've learned over the years is that the markets are not a static thing. They're always in flux. Volatility is elastic. It's always in flux. And our job as traders is not to necessarily say, hey, I'm only going to trade this one market per se. It's to adapt to the market and trade that. Tulips would have been a great thing to trade during the tulip crisis. But then after it crashed, you really didn't want to trade tulips after that. And you could have stayed there and be like, oh, I'll just keep trading tulips. But maybe there's no more market for that back in the day. So our real job as traders is to always adapt to the markets. If somebody wants to stay with Forex and they feel like, hey, I need the leverage, I don't have the size account, it's easier for me, it's harder to trade stocks or whatever country I'm in, then my suggestion would be to try and trade a broker with as many currency pairs as possible, so you can have as many instruments as possible to trade. And I would try and find a way to trade where you can understand what's going on in the order flows in the currency markets and then trade that. If you can do that, then you can build a set of skills that will help you with Forex. But if you ever decide to go to another market, you'll have the skills to adapt to another market.
I think the most important advice I can have is that whenever it comes to trading, you want as many stars in your favor or check marks in your favor as possible. So you want to select trades where you have your technical setup, where fundamentals are on your side and sentiment is on your side. If any of those are violated, then maybe you want to reconsider your trades. You just don't want to take it blindly. You want to be able to look at the bigger picture and make sure that you have as many supportive reasons for getting a trade as possible.
These kind of themes that you see around many traders that they have in common, are there some things that you have to be able to focus on, you have to do to be able to become successful?
The answer to that is yes and yes. They certainly have certain things in common, but they also are all different. They all use different methodologies. They have different personalities. They trade different markets. They have different time frame on their trades. So there's not commonality like that, but they do all pay a lot of attention to risk management. They all are very disciplined, some extraordinarily so. I think all, if not most, if not all of them, pay a lot of attention to the psychology of trading, to their own mindset, to where they emotionally are at the time they're trading, what emotional influences are they picking up about themselves that could impede their trading or might be a clue to how to trade. So there are like those type of similarities. The ability to get out of their position in a split second if they think they're wrong. So those are types of commonalities, but not methodology wise.